So, over the last few years, many Indian startups have domiciled their holding or investment company outside of India, with the main focus to be able to raise capital overseas easily. The funds that they raised overseas would typically be parked in foreign banks. So, Silicon Valley Bank was one of the most famous ones. And what happened in the recent, over the last couple of years, rate hardening cycle in the US is that the income, the treasury income that Silicon Valley Bank was actually earning on the deposits received from Indian startups, Indian and other startups, and then subsequently invested into various US securities was lower than the obligations they had on the payment side to these startups. So eventually, that was a treasury management cycle that was bound to go bust. And the minute this news came out, startups started withdrawing their funds out of the bank, and the bank collapsed. So at least the positive news now is that there will be some kind of support provided by the US regulators, and hopefully startups will not end up losing their money. A very big learning out of this is that it makes a lot more sense now for Indian startups to open local domiciled accounts in multiple banks as well, to be able to diversify their liquidity and treasury risk. So rather than park a lot of their surplus liquidity in one bank, whether it is in India or abroad, it makes sense to park it in multiple banks, and a large part of it being local over the next year or so. Given the funding winter that we've been talking about extensively as well over the last maybe 2 quarters or so, 2023 is likely to be a challenging year in terms of fundraising environment, and we'll probably see the re-emergence of startup cockroaches, so as to say, which essentially means that startups will focus now on bootstrapping, keeping costs low, focusing on growing revenues as opposed to chasing relentless hyper growth. And conservation of capital will become key. So the learnings and in conclusion, the takeaways from the Silicon Valley Bank matter as follows. One, it makes sense to kind of diversify risk by not just raising money overseas, but looking at local capital as well, both in terms of debt and equity. Second, treasury and liquidity management must be done very actively, as opposed to simply just parking all of your liquidity in one bank where you feel the interest that you're earning on your fixed deposits is the highest. So my only recommendation to startups is please manage your liquidity and treasury very, very prudently, diversify risk, park it in multiple liquid instruments across multiple reputed institutions, and try and insulate yourself from this kind of black swan event as much as possible.